Welcome, Green Wealth community. We're happy to have you here today. I'm joined by Drew Heatley. My name is Alan Green. We thought we would talk a little bit about what's going on in the economy and the markets to give you some sense of what's behind the scenes in either your portfolios or what you should be looking for. So why don't we start, Drew, a little bit talking about the economy?
Thanks, Alan. The economy, as we all know, is so important to our everyday lives, both to our employment and our personal prospects, but also for the opportunity set that the market has to operate in. Right now, in aggregate, as you can see on the chart above, the signposts that we really measure for all look pretty positive. There's only a few exceptions, but for the most part, they've stayed pretty steady for the last couple quarters. If we dig a little bit deeper into the quarterly numbers, though, it looks pretty strong. Dating back to basically for the last 4 years, the economy has been very strong and very resilient. It's only been really the first quarter of last year when tariff policy kicked in that we had any hiccups. In fact, those hiccups were really just brought about by an imbalance between imports and exports, as you might imagine, with tariff policy. But the consumer has stayed so resilient and is really what's driving the strength in the economy right now.
What else are you looking at other than some of the things on the slide that an investor needs to be aware of?
Yeah, the fundamentals look really good right now with the economy as we just reviewed, but the story doesn't really stop there. Actually, kicking in right now has been a lot of the benefits of interest rate policy over the last 12 months or so, as our Federal Reserve embarked on a rate cutting campaign in 2025. And while we're holding tight recently on rates, it's likely that there might be 1 or 2 cuts ahead of us. And even if rates stay neutral or drift lower, that's going to be a big stimulus for the economy. And again, that's not where the story ends either. We also have the One Big Beautiful Bill Act, if I can get that all out,
Nice job.
OBA, thank you, which has a lot of policies kicking in 2026.
Sure
in
does.
fact, as the chart shows, a full percentage point in GDP activity is expected in the first half of the year from the benefits of that bill.
Yeah, I've been telling clients that they should expect to either owe a little bit less or get a little bit more back, depending on their situation. Are there any other points that we should consider if we're an investor today?
Yeah, I think so. There's a few things that we want to keep an eye on. One, of course, is the labor market. If you remember from the dashboard we showed earlier, one of the slight negatives at present is labor sentiment. Part of the reason why the Fed kicked off on the rate cutting campaign last year was because of some ambiguity about the health of the labor market. So as you can see on the chart above, the unemployment rate is 4.6%, and probably over the last couple of years has risen almost a full 1.5. And typically that has been some cause from concern in the past, but we just don't see it in the numbers yet.
Sure, 4.6 seems like full employment. So anything else out there that you're looking at?
Yeah, I think in general, too, you have not a day-to-day worry, but more of a longer-term worry that does play out from time to time in the market, and that's around the federal finances. So the budget last year really showed about a $1.8 trillion deficit, which has added to our about $40 trillion total national deficit. And so that just raises questions day in and day out about where our finances are headed and how we ultimately can service this debt over time, which does raise some questions typically into the market.
Sure. And I know we've seen some moves around interest rates, and there's some focus around what they call the bond vigilantes.
Yeah.
Anything else out there?
Sure. Well, we all know that over the last 5 years, inflation has really been a tough pill to swallow for everybody. In fact, as we're estimating, the cost of living went up 50% in the last 5 years,
Wow.
which is just hard to handle at the end of the day. And it's also kind of leading into some imbalances that we're seeing with something called the K-shaped economy, if you've heard that buzzword.
Yeah, I wondered if you were going to bring that up.
Yeah, it's kind of an interesting term, but it basically is the end result of inflation affecting some people positively, those who are typically in the higher income brackets, and affecting those negatively who are in the lower income brackets, and kind of that differential between the two. Essentially what it means is that over the last 5 years, if you've been able to accrue equity in your home, returns on your stocks, interest from money market funds, you've accrued an excess that you're now spending. As you can see from the chart above, the top 20% of earners are spending $41 trillion midway through last year, when the bottom 80% has only been able to spend 16.
Wow.
Big difference between the two.
Certainly a big difference. Is that it?
I think that's probably the biggest factors at play, or the 30,000-foot view on the economy. Again, providing us the backdrop or the environment to be successful with investing.
So the economy sounds like it's in pretty good shape with lower interest rates and some stimulus from one big beautiful bill. What does that lead your outlook to be regarding equities?
Thanks, Alan. Stocks are clearly, I think, what's on everybody's mind when it comes to investing usually. So stocks right now, as you can see, are at all-time highs. Valuations are full, as they typically are, on the way to all-time highs. And so a lot of people are asking, what's really driving the performance in stocks right now? Well, in our mind, it's the earnings, the fundamentals that are really driving stocks right now. As you can see, basically last year, the earnings environment looked pretty robust. And we're talking about 10% growth rates over multiple years, both actual and estimated. And wouldn't you know it, by the end of last year, those estimates were actually raised, which is really driving the stock market performance. I mean, we're really looking at double-digit earnings growth for multiple years in a row if the estimates hold true, which would lead likely to good returns in stocks.
Interesting. Do you think that's all because of artificial intelligence?
Well, with the amount of money being spent by many of the Mag 7 companies on the infrastructure and the capital needs for the AI environment, actually over the next 3 years, it's estimated to be about $1.5 trillion worth of CapEx. It's no surprise that a lot of that actually is being driven by those companies.
That's a lot of zeros. How about the international market?
Yeah, we talked a little bit before about geopolitical risk, but there's actually a lot of geopolitical opportunity outside the U.S. If you look at the chart we're showing, you can see that most people are underallocated to the international markets, and you'd have to ask yourself why, because they represent a big part of the global economy, and that really represents an opportunity to be diversified away from some of that concentration that you mentioned in those few stocks.
Sure. Anything else on the equity front that we should keep our eye out for?
Well, if I could come back to the international markets for one moment, last year, as you can see, they did really well. And so a lot of investors are asking, why did international markets do so well? Well, one big factor there is the dollar. The dollar has a lot of impact on a lot of different things, but as it relates to international stocks, they love nothing more than a weak dollar. As you can see, the performance for international stocks looks really strong in a declining dollar environment.
And it seems like the administration doesn't worry as much as maybe previous administrations about the strength of the dollar.
That's right.
How does that play into something like fixed income? What's your fixed income outlook for 2026?
Fixed income outlook is, probably kind of the forgotten child, maybe the third or fourth child if you have multiple kids. But really, fixed income had its first good year in a while, and that's really on the heels of declining interest rates. But if we kind of look at the opportunity for us to move forward with fixed income, usually your returns in fixed income come from your starting yield. As you can see, here's kind of the framework for interest rates for various fixed income asset classes. That's kind of the opportunity set that we have, and it still looks pretty good. And if the Fed cuts interest rates a time or two again, we should end up with another pretty good year for fixed income.
I know one of the things that we've done for clients for a couple of years now, since the Fed aggressively raised interest rates during COVID, was to help people with their cash. Do you see cash getting transitioned into fixed income as yields come down?
I think that all depends on where the Fed goes from here. Most investors, I think, rely on high yield savings accounts, or they rely on kind of the bank sweep that they might get in their checking account for their cash returns. But as you and I both know, clients can benefit from more active management with their cash. That could be laddering treasuries, Al. It could be investing in kind of the select money market funds that we have available through our custodians. And sometimes it could even be a combination of all of those.
So having covered both stocks and bonds, let's talk about my favorite, alternatives. Maybe start by telling clients why we use them and what benefit they provide.
Great. And as you know, our goal is to provide our clients with a core asset allocation that they can use to reach their goals. Over the last number of years, it's become increasingly clear to us that you need to have a third leg of the stool other than stocks and bonds. Bonds were a pretty big failure for investors back in 2022. And as the Fed started to raise interest rates, again, it became clear to us we needed to seek diversification from other places than just bonds.
Right. So, what types of alternatives would you recommend? And again, what benefits would they provide by mixing them with stocks and bonds?
Sure. Well, part of the reason why we felt like we wanted to move away, again, more than just anecdotally, is that correlations or the relationship, the interconnectedness of stocks and bonds has been rising over the last number of years. It used to be that bonds would move in the opposite direction on a down day in the stock market. But as we realized, it started to happen less and less frequently. So correlation benefits are really the number one kind of technical reason why we like to incorporate that into portfolios.
So, in a year like 2022, where stocks and bonds lost a large amount of money, the bonds didn't serve as the ballast to stocks in your portfolio.
That's right.
So, what else about alternatives, Drew, should our community know?
Well, what does kind of provide you those correlation benefits? Ultimately, at the end of the day, we're looking at asset classes that are going to be private in nature. So private equity, private real estate, we're talking about private credit, or it's going to be kind of a differentiated strategy like a hedge fund or managed futures or some real asset strategy that's going to provide a little bit of vig when the market zag typically.
Yeah, I've read some stuff in the Wall Street Journal about private assets getting introduced potentially into retirement plans so that people can get more access to them. It's an interesting concept. Talk a little bit about the metals and gold and silver.
Great. Commodities serve as an underinvested asset class, and gold is probably the most famous, especially lately, of all the commodities that are investable. We all have had some experience likely with gold throughout our lives, whether it's something that we own personally or it's an ETF in one of our investment portfolios. But gold provides a lot of those benefits we talked about earlier, diversification, correlation benefits, and it really ties back into what I mentioned before about our federal finances. Part of the reason why gold and other real assets like other metals have done so well in our minds is because of the increased questions around our federal finances. If you think about any kind of borrower, if they borrow more and more and more, there becomes at least increasingly more questions about their creditworthiness. And in our case, as a sovereign nation, folks will look to hedge some of that risk through things like gold, which has historically been kind of a store of value or an alternative to the traditional financial system.
Interesting. It's not only people, it's also foreign central banks doing this. Can you give some idea of what types of outcomes can be provided by alternatives? How have they done in the past?
Sure.
What's that look like?
Well, really across any investor type or at least risk level, or said another way, any kind of goal preference, alternatives can be beneficial. It's pretty much been shown that including alternatives as a part of a balanced portfolio will reduce risk over time and increase return over that same time frame. That ties into something called modern portfolio theory and the efficient frontier, but without all the buzzwords, just adding something like that to the mix as part of a balanced portfolio has proven to be pretty good from those outcomes.
So you own stocks, you own bonds. What percentage of your portfolio should be in alternatives? How do you determine that?
Well, really, as it comes down to with a lot of things, it comes down to your personal plan and the financial planning outcome. But it is a part of our process to use alternatives for our clients as a way of achieving those diversification benefits I talked about before. The question then becomes, what's the percentage of a portfolio? And that could probably vary anywhere from, call it 5% to about 20 or so. And that's usually kind of, again, determined by our financial planning process. Now, it's not like we're inventing the wheel here. Institutions have actually been using alternatives for those long-term benefits over a longer
I mean,
period.
like
of
endowments.
Yeah, like an endowment or a pension fund or a life insurer where they have kind of the opportunity to put this capital to work in some of those private markets.
How about some of these very wealthy families, think billionaires?
Well, I think they're definitely investing. It's probably about 20 to 25% that they're allocating to these areas. If you think back to the market concentration observation that we had before, if 40% of the S&P 500 is concentrated into 10 stocks, you really just have a smaller and smaller sandbox that you can play in for public stock investing. Why not open yourself up to the millions of private companies that exist out there that you can invest in through private equity and similar ventures?
That makes good sense. And so, what does the introduction of alternatives, just to wrap it up, how does that help the portfolio? What's that real benefit?
The real benefit is that with enough presence in the portfolio, no matter if you're a conservative investor or an aggressive investor, you tend to over time see your risk level decline and your return potential increase on average.
Isn't that what everybody wants?
That's what everyone wants up until
No risk and the highest rate of return possible.
Yeah, that's right.
Just to wrap up, Drew, 2026, a lot of pundits out there, strong economy, market at all-time highs. We talked about the correlation between stocks and bonds. We talked about diversifying with alternatives. Any final thoughts?
On the investment front, I think sometimes it's easy to forget the big picture. And usually it's the big picture that drives over a long enough time frame, called the medium to long term. And that big picture looks pretty rosy with what we can see and measure. But as we all know, there's curveballs. No one expected a pandemic to occur. Nobody expected Russia to invade Ukraine. There's always going to be something that comes out of left field that introduces volatility into the mix. It's really through the financial planning process that we can provide assurances to our clients that they're on the right path despite the volatility. And it's our other job to make sure that the portfolio matches that planning process.
As said differently, we want to build the roof in good weather and not fix it in the hurricane.
That's right.
Thank you for joining us today. We're here should you have questions on your own portfolio. We look forward to shepherding your wealth and growing it in 2026 and beyond.